Good morning, everybody, and thank you very much for joining the London FX Open Breakfast. We do appreciate you coming, and thanks very much. The sun is shining in London for once. Literally about the first time I've seen the sun since for a couple of weeks. So, today's a better day than it has been, certainly in London. So that's all good. But let's get cracking. And the key thing to note is that London has just opened, and we are slightly higher, I believe. We've had a slightly higher open, but we are really moving into tentative territory. As one can imagine, a lot's been going on since my Monday's webinar. We obviously back then we said that the rally looked a bit weak above 126.25, and we actually throughout the webinar we actually saw it come off. Well, that's been kind of that's been clarified now. Obviously, Spanish bond yields have started rising at a very high level. We've obviously got a huge amount of event risk coming up this weekend, what with that Greek debt auction. But we're going to take a look at just a few things and just to show you kind of certainly some levels that we're looking at. I'm also going to look at oil a little bit because there's some interesting stuff going on there. Obviously, as there is with kind of the commodity space and just what to expect really. We're not always right, but we certainly do try. So the first thing, gold. I've not been too well the last couple of days. I do apologise if I cough and things like that. I'll try to turn chart stroke, lipping, which is what I mean. This is gold XAU. It's an hourly chart. As I said, had a bit of a rally. This is a story of gold. Gold has actually been a really key mover over the last couple of weeks. We had that huge jump higher when we had payrolls out at the start of the month. This move here is the decline from those highs. We got as high as 1640. This decline is Bernanke being fairly hawkish last week. This mini rally here is on the back of an overall kind of boost to risk sentiment from what we heard from Europe and the Spanish bailout over the weekend. But as I said, since then, it's really just sentiment has just been slipping away. Interestingly enough, there's some really, really key support here around just below 1610, which is where we're testing at the moment. So this, to me, as you can see, bit of a triangle pattern going on here. Just draw that for you. I guess you could draw it from there, or you could even draw it from here. Now, it looks slightly vulnerable to me, actually, because we've had a series of lower highs. Now, that seems to be tipping a little bit here. But, basically a breach below 1610 could certainly open the way. Obviously, 1600 being a big round number, that's going to be important. And then potentially even towards these 1590, 1585 to 90 lows that we saw not that long ago. Remember, gold does move very, very quickly. So, we could see 70, if we get an anti-bailout party, for example, win on Sunday for the Greek elections, whenever we hear those results, maybe late Sunday night going into Monday, if we were to get a negative result from that, we think that gold would probably act like a risk asset and it could fall all the way back towards that kind of those 1560 lows down here. So it's not beyond the realm of possibility. What I guess I'm trying to say in a roundabout way is that we could be range trading for a little bit, or range trading into the weekend. Now, as I said, European stocks have opened the day higher. Sentiment, there is some sentiment there, but it's not all there. There is still an awful lot of uncertainty around this Greek general election. I think it could go one of two ways. If we get an anti-austerity party in, we could see gold and other risky assets fall off a cliff, potentially move back to edge back towards that or shoot back towards that 1550 level, maybe even go lower, because obviously then you have a huge amount of uncertainty about whether or not Greece remains in the Eurozone. However, if we get a pro-bailout party, and I say that in inverted commas because obviously they haven't really been that pro-bailout, any of the parties, then we could easily see a very, very strong relief rally, maybe above this 1640 level, potentially all the way up to 1700, because that would not be perfect, but it would mean that there's a little bit more certainty, and it would probably help take out the tail risk of a disorderly exit from Greece from the Eurozone. However, because we don't know where we are, we don't know who's going to win that election, because remember, there's blackout on pre-election polls in Greece for 2 weeks prior to the election, so we go in blind, if you like, as commentators. We are range bound. I would think, into the weekend. But or certainly for the rest of this week. So as I said, 1620 on the upside, potentially 1590 on the downside, maybe even 1600. It could be a fairly tight range, especially for gold. And we don't believe this is just gold. I'm just using it because I kind of like the chart. And as you can see, this is the daily, so tons of lines. I do apologise, but it's really it has been range bound essentially in a $100 range. And we're going to need the outcome of that Greek election, maybe even some, added to that, of course, now that Italian bond yields are in danger territory, the markets really do think that the Eurozone will react. So, to bust out of this range here with kind of 1540 on the downside, 1630 on the upside, we're really going to have to get some answers to these fundamental unknowns, the Greek election and also the EU summit at the end of this month. So there could be, some major event risks that could really shift kind of price dynamics, because really since kind of the beginning of this month anyway, we have been kind of stuck in a range with people talking more about, or people, the market trying to weigh up the various risks that have been going on. But one thing that I think is very interesting is that the market hasn't gone nuts based on Spanish bond yield, based on the massive rise in Italian bond yields. And I just want to show you something really quickly. Obviously, Spain has been dominating the headlines for good reason, of course. But there's another chart that I think is actually more worrisome and is something that more people are going to be looking at. And this is the Italian bond yield spread. So it's the 2-year yield, the 10-year yield, minus the 2-year yield. Now, in the current environment where we're pretty worried about what's going on, or we're worried about heightened levels of credit risk, one would expect that chart to move upwards from left to right. So move kind of up in kind of a nice kind of arrowy shape. So as you can see, by and large, that's what happens. But it's not, it's not that clear cut. Obviously, there are going to be some kind of issues there with rate cuts and stuff from 2004. But basically, from kind of 2008, we really saw the 2-year yield was. Someone's just asked me to give my views on gold. I just did, actually. I said that we're going to be range bound between 1540 to 1630, and it's going to really depend on kind of what goes out. But right now, below 1610 opens the way to 1600. But I do believe that we're range bound with 1630 obviously being massive resistance on the upside until, of course, we get the outcome of that Greek election. So maybe you just joined a little bit late, but that's I just spent a while talking about gold, so I won't be talking about gold anymore. So this is the Italian. So as I said, you normally expect it to be kind of moving higher like this, going from one side to the other, which it by and large has done over the last kind of 15 years. But what we've really seen, so basically throughout kind of this sovereign debt crisis, we've really seen short-term yields start to fall off start to rise at a faster pace than long-term yields. Now, partly that's because of pledges to keep interest rates low, LTRO auctions, that type of thing. But when you get these real choppy moves, as you can see, with bond yield spreads, they don't really move that much. They kind of move in very measured, very measured way. They're not kind of jerky. But what we've got is these kind of very jolty movements in this yield spread, which really suggests sovereign stress, credit risk stress in the currency bloc and in Italy. So we've got the 10-year yield when it starts to fall versus the 2-year yield, which is what we've seen over the last couple of days. That's real stress. That is when investors are more worried about kind of shorter-term debt than they are about long-term debt. So this was what happened back in November when we got LTRO. Now, we're not back there yet. Purely because even though 10-year yields have risen to a record high, 2-year yields have been a bit slower to come off. But as you can see, very jolty movement. We've covered a bit today, but we're going to be looking at this chart very, very dramatically. And the reason why, I know you don't trade this, but this is a really important one to look at. Back then, when we got to these kind of extreme levels whereby the Italian bond yield was nearly inverted, so it nearly meant that 2-year yields were above 10-year yields, that was when we got the ECB LTRO action. So it seems to be whenever we get either stress in credit markets or heightened levels of volatility that the ECB then acts. If we see Italy get even more dragged into this fray than it is already, we could see the ECB act. And what does that mean? Well, that would probably mean a very strong relief rally. So trying to predict when the ECB will act is, some people may argue, a fool's game. But this chart probably gives you the best idea of when they may think about it. Okay, so I want to also start just looking at some currencies now, because obviously I work for Forex.com, so that's what I should be doing. Right, let's get to euro. This is euro dollar. This is just a daily chart. As you can see, range, very similar to what we're looking at in gold. It's kind of caught up in a range. We've had our decline. We haven't been able to manage to extend gains. And this has been kind of the story of it. Now, even after the Spanish bailout, added to that, we also got, of course, that spike higher in Spanish and that spike higher in both Spanish and Italian bond yields yesterday. We really haven't had a huge impact on the market. So this was the decline. This was the gap higher that we saw at the Asia Open. As you can see, huge gap higher. But a bit of an exhaustion gap, really. It was almost like, well, investors were delighted that something had been done, but then once we got to 126.50, they were exhausted. The bears were then coming in and selling this very, very sharply, as we can see. And after kind of totally filling that gap, getting back to these lows here at 24.50, since then we've really been trading range bound. Now we are getting to near the top of that range, and we have got a congestion zone coming up, including this 100-hour moving average here. I believe that we are going to be range bound, and I think that probably gains may be capped around about the 125.80 to 90 mark as we lead up to these Greek elections. The reason why I say that is that, you know, to move back towards 126.50, I think we're going to have some fundamental shifts. And I don't see that happening until Friday. So, you know, obviously, you know, where are we looking right now? Let's go back to our daily chart. To the downside, we've obviously got that kind of 123.50 and a break of that towards 120 on a more longer term basis. If we get some negative news out of Greece and more news out of Spain or Italy. However, on the upside, obviously, we also have this kind of 126.25 is your key near term resistance level in euro dollar, and then above there, 127.50 on the way up to 130. But again, the fundamental picture has to shift in the short term, really, to kind of get us to shift out of this range, because this range, as you can see, you know, as I said, there's plenty of fundamental reasons for that. Okay, I've had a couple of questions which are really interesting, just looking at this Eurozone crisis. Could the ECB buying long-term debt since market? Okay, could the ECB be buying long-term debt, and is that what's kind of causing this mismatch, whereby shorter-term debt is rising at a faster rate than longer-term debt? Well, actually, no. One thing we do know for sure is that the ECB isn't buying any debt. They report on their debt buying. They have to every Monday, and they have not restarted that program. So no, this is all about the market, and the market, or those people who are holding shorter-term Italian debt, are selling that debt, or there is some selling pressure on that debt, maybe because they're nervous about the near-term outlook for Italy. For example, obviously Italy will also be hit by what's gone on in Spain, in the sense that their private sector bondholders have been pushed down the pecking order with this bank bailout. So if Spain is to default, European institutions like the ECB, like the EFSF, for example, would actually be paid back quicker, or would be first in line for a payback ahead of private sector bondholders. So that's also impacting it. Someone's just said that Italy's got a good relationship with China. Not many people talking about Italian bonds. Can Italy's debt be a problem too? Well, when you have 120% debt to GDP, a 2 trillion euro debt burden in the current environment is just not a good situation to be in. It's not in any way. They've lived with it for years, but now is not the time to have it, really, not when there's so much scrutiny on public sector finances. So we would argue as well that it's not a great thing to have, that Italy's debt levels are a problem, hence why its bond yields have been rising so high. There is no mercy being shown by the markets now. They're worried that this could be a bit of a problem. Someone's just asked as well an interesting question: has Spain formally requested a bailout for its banks? And is it the 100 billion? Well, interestingly enough, yes, they have formally requested a bailout, However, the 100 billion is what the EU has suggested they would give them. However, Spain has said, well, we don't know how much we want yet until we get that audit on its banking sector to get its true liabilities. So hopefully that audit won't come back and say, well, it's actually 150 billion. But 100 billion sounds about right and is the top level of estimates. If anything, I wouldn't be surprised if the audit came back and said maybe it was a bit less than 100 billion, maybe 70 or 80 billion. Okay? When is the audit out? We don't have a firm date, but we believe it should be around about in the next couple of weeks, maybe a month. Someone's just asked about Aussie dollar, and I'm going to definitely look at Aussie dollar because that was really interesting. Obviously, it's interesting for a couple of reasons. Number one, because it's considered the most the riskiest currency on the FX spectrum. Number two, there's some domestic factors going on there. So we've obviously had rate cuts from the RBA, but we also had Australian official today come out and say that they don't want the Aussie to fall too quickly because it's pretty good for inflation. So they do need to be a bit careful. So they're basically not saying, so what the macro picture for the Aussie dollar is fairly weak, but there is some concern high in the kind of the upper echelons of power that if a total outright collapse in the Aussie could even be worse. So let's just take a look at this hourly chart. So again, there is that gap, bit of an exhaustion gap since fallen back, but it's had a really nice move higher, and we're actually in a bit of an uptrend. The Aussie has bucked the overall trend from the weaker euro, for example. So as I said, the euro very much trapped in a bit of a range. Let's take a look at this daily here. Well, the Aussie dollar has actually been having a really nice uptrend. Now, the reason why we think is because China has been cutting. China cut interest rates, took some bold action to try and boost its economy. Its export data was also much stronger, which is all good news for the Australia because that is its largest export partner is China. So that's all good news. So even though that didn't affect the Aussie dollar straight away, it took a little while for concerns about what was going on in Europe to calm down, and for the Aussie to really start rallying on the back of or start making gains on the back of what's been going on in China. So I would say that I'm neutral on Aussie dollar. I would say that right now, if we get we've obviously kind of broken the bar. I think we could potentially run up back to parity. Maybe even to 100.30. Let's get back to the hourly chart so I can show you that a bit clearer. I think we could definitely get back to parity. I think 100.30 is going to be key resistance. I think we will be capped there until we get the outcome of the Greek election. But right now, I think, the fact that we've had such a strong bounce back over the last couple of days, we've also kind of been up and tested parity, obviously, on Monday. That to me suggests that we could make another run up at it, and also there seems to be a bit of fire in the belly of the Aussie bulls at the moment, possibly on the back of what's kind of going on. Someone's just asked how the outcome of the election would affect the Aussie dollar. I assume you mean the Greek election. Well, because it's so sensitive to risk, a negative outcome from the Greek election could cause it to fall. A positive one could cause it to rise. So, again, I'm just giving you some levels for the next couple of days. So I would say on the downside here, 99.20 is acting as really, really good support. And then we've got kind of 98.50. And on the upside, as I said, 100.25. So we need to get above there to kind of make further track. And again, we think we're going to be kind of range bound in that 100-ish pip range. Between now and Sunday. Someone just asked about sterling, which I will happily do, and then I'm going to take a look at oil. So as you can see, sterling's been fairly similar to what we've seen in the euro. It's very much range bound. It hasn't fallen off as sharply. Let's take a look at it on a daily basis. So as you can see, it has had a bit of a rally. There have been certain things that have been that could potentially limit it. As you can see here, 156.10, could potentially thwart that. That's the 21-day moving average, really key resistance level there now. But what we've really seen is a nice kind of recovery in sterling. So, obviously it's fallen off quite sharply. Euro, all the currencies have really been fairly resilient compared to what's going on with, Italian and Spain's bonds. And as again, as I said, I think it's the market's kind of jumping to the conclusion that if things get bad and if Italy gets dragged into the fray, that the Eurozone authorities will act. So right now, it's going to be really important to look at who's saying what, who's speaking? Well, we have got some speakers later this week from the Eurozone. That's going to be really, really important. We also have Merkel speaking today, and she may talk about Eurobonds. So do watch out about that, because any kind of negative sentiment, basically I think this rally, or this kind of consolidation period that we're in, if it's going to turn into a rally, we're going to need a shift in the fundamental backdrop. Right now, to me, it's still consolidation. So I'm a bit more neutral on sterling. Generally, probably a bit more bearish on euro at the moment. But really nice kind of move higher there. Obviously, as I said, 156 is a really key resistance level, with kind of 155.10 on the downside acting as very, very good support. So again, as I said, I wouldn't be surprised if we could see some negativity. So someone said, wouldn't Eurobonds be good for the euro? Indeed, they would, but it's whether or not Germany agrees to them. And we could hear get a bit more colour on that, because Merkel is talking to her parliament later on today. So again, no Eurobonds is bad for the euro, probably bad for overall risk appetite in the short term. And euro, yes, if she sounds like she's softening her stance towards Eurobonds, that's probably a positive thing. So yeah, sterling, very much into kind of recovery mode, but we are in consolidation mode here. Now I do want to show you something else. Just bear with me one moment. I've also, just for those Aussie people interested in Aussie, I've just heard that there are some stocks in Aussie at 99.70. Euro stocks are going through. So basically, if we can get above 99.70, it does suggest that we may get all the way back up to parity, potentially even to 100.35, as I said. Just bear with me one moment. I'm just bringing up the chart that we have. Just want to show you oil, and this is WTI. So WTI oil, as you can see, had a bit of recovery, very much in consolidation mode, but really needs to get above this 85 level to be able to kind of rally back. Now, the one thing I would say is that we've obviously had our short-term moving average, so the 50-day, which is the pink line here, cross below the 100 and 200-day moving averages, and that's actually quite a that was based on, and that's, a bearish signal for this. So consolidation mode, yes. Above 85, we need to really get back above 85 to be able to target 90, of course, but 85 right now really thwarting the bulls. 80 is a really pivotal level. So as you can see here, back in September last year, we had this kind of hammer pattern here, hammer candlestick, just below 80, so around 77, which suggested that we were at the bottom, we were turning, and then that did trigger a nice sharp rise up to 110. Well, we potentially need to see something similar to be able to make any type of recovery, and if we don't, then below 77 is a really key level, and if we were to break below there, that would be significant, very, very significant for WTI. Now, someone's just asked a question because they joined a bit late about euro, which I will answer. Just bear with me one moment. Just because I know that there was some funny price action on Sunday night. So those of you who are maybe new to trading FX or haven't traded FX for a little while, so this basically, I think, let me just put this back on. So basically there was a very sharp rise, so there was a gap higher, and then we kind of fell off throughout the day. I wouldn't necessarily say it was a quick fall, but we did certainly fall off quite sharply. Now, someone's just asked a question about oil, and I will go back to that, but let me just discuss this first. So basically, no, these gaps happen. They tend to happen. They're very normal. They tend to happen when there's a lot of bids put in, maybe after a fundamental event, obviously like the Spanish bailout. However, when we see, so we've obviously got that Spanish bailout, that caused the market to gap higher. That's not market manipulation. That's generally caused by a close on a Friday at one level, news coming out on the weekend, and then a jump higher because there's tons of bids coming in at a higher price on the Sunday night. But what happened was with that, we got an immediate knee-jerk reaction, and then sentiment tended to dip because really people were worried about the fact that, if anything, this bailout has probably made Spain's finances worse, which probably means more austerity, which probably means less growth, which probably means Spain's going to miss deficit targets. In fact, Fitch came out and said that. That's a rating agency last night. So overall, yes, the banks are sorted out, but no unemployed people in Spain got a bailout. And we do know for sure that there's a lot of unemployed people in Spain. Added to that, we need growth to really get us out of this mess and to really reduce credit risk. And that's one thing that we don't have. And funnily enough, this bank bailout has potentially made it even worse, or made credit risk in the currency bloc even worse. Okay, now someone's also mentioned, just to round that off with euro, I said that we're very much range trading now as we lead up to the Greek elections at the weekend. We could potentially even get to kind of 125, 60 or 70 on the upside. 125, 25 is quite strong support. Again, if we just get back above 126.25, we may head all the way to 126.50, but there is event risk that could knock it off its course, with the downside very much being 125, and then below there 123.50, and then of course 120, which is the key level. Okay, someone's just asked another question about oil. Could we get down to 76 in 2 weeks? Well, yeah, we absolutely could, but it does depend on the fundamental situation. We could get down to 76 in oil pretty quickly. It can move very, very sharply. So if we were to get some negative headlines today or tomorrow, that could really see us push down to the 76 zone. But it does, but again, as I said, what could stop it from falling below there, or even stop it from falling convincingly below 80, is the fact that there's some resting expectation that the Eurozone sovereign debt crisis won't be allowed to spiral out of control. Now, okay, everybody, that is 8:30 now. Thank you so much for joining. We do hope that you enjoyed that, and that you can come and join us on Friday. But one thing I do want to just point out to you is that tomorrow I'm doing another webinar. It's more of a kind of a learning webinar, really, a bit more educational about how to trade around news events and the dangers of trading around news events. And some of you might find that useful just from kind of the questions that you're asking me. That will be 11 o'clock tomorrow, so 11 a.m. UK time, which is 6 a.m. Eastern time and midday Central European time. Do please join me if you can. You can sign up. It's on the FX Street website, but it's these special webinars. There's a few of us doing them. My slot is at 11 o'clock. I'd love it if you could all join. If not, then I'll hopefully see you all on Friday. So thank you very much. Bye-bye.